When I look at this chart, I would agree. If I could ask you all to take one image away from today, it would be this chart. Hopefully you can see two skews. So there's clearly a skew in terms of the winners are much greater than the losers, but also hopefully it's quite evident there's a much greater win to loss ratio than just flipping a coin. I think when it comes to investing, I think one of the mistakes that a lot of people make is they spend too much time focusing on investment returns and not enough time focusing on investment risk. And in the investment game, both of those things are equally important. You can't get away from that. I think one of the reasons we spend so much time focusing on investment returns is they're just much easier to understand. If I asked you how much your portfolio made last year, you could give me a very precise answer. If I asked you how much risk you had in your portfolio last year, that's a very cerebral kind of question that's hard to quantify. And just because it's hard to quantify doesn't mean it's any less important. There are some very funky mathematical formulas that do quantify risk that are not really fit for purpose and leave us all a bit befuddled. But I've always felt that this chart really summarises what we do at GVF, which is I'm very proud of the returns we've generated, but I'm just as proud of how well we've protected capital. And I always like to think it's a bit like skydiving. You always pack a reserve parachute. You can probably get away 99 times out of 100 without the reserve parachute, but that one day that things go wrong, you're going to be pretty happy that you had the backup in place. Hey, Jane.
Miles, just on risk, and I absolutely agree with you, it's underestimated as a driver of return, but can you just talk about a little bit about how you quantify risk or what measures you use to measure risk?
Yeah, so just because we're recording, so Jane's very sensible question was if I could give some insights into how we quantify risk at the Global Value Fund, how we measure it, and I think how we take it into the portfolio. I guess if I just I'll speak a bit freely.
Please.
When you're trying to manage risk, the theory 101 is the best place to start is with diversification. So what you want to own is as many different kind of asset classes that have as little correlation to each other as possible. And if you can find 10 investments that are all going to behave completely differently to each other, then you hopefully, over a way you've constructed your portfolio, you'll be able to survive with whatever the market does. If share markets go up, typically bond markets go down and vice versa. That's sort of the famous one in finance. Apart from constructing, looking at risk in a portfolio sense in terms of how we can manage risk, keep it as low as possible while still keeping return expectations as high as possible. For what we do in our strategy, it's really the old-fashioned value investing. Benjamin Graham, the father of value investing, his thesis was you buy things with a margin of safety. So if we're buying things cheap enough, then a lot has to go wrong for us to lose money. Obviously, we can have situations where things lose money, but if we're buying something that gets 70 cents on the dollar and that dollar's worth of assets falls by 30% and we still get out at NAV, we've weathered essentially a big fall in the market and not lost any money. And I find with this chart, the best way to explain that, really, that margin of safety, is to look at these ones in the middle. So everyone's eyes obviously gravitate to the winners, and then everyone's second thought is, well, what are the losers? But really the trades that haven't worked for us are these big gap here in the middle. So things that we bought that haven't worked out, but because we bought them on such a big margin of safety, it actually hasn't caused us a capital loss. It's more just we've tied capital up and not made any money on it, time value of money. That's risk and reward at GVF. In terms of, do you think I could ask you to click along?
Sure. I'm a clicking lady. I'll wheel around.
In terms of sort of the big picture and what I was hoping to say a few words on today, I wanted to say a few words on inflation, which is obviously enormously topical at the moment, and then to touch on one of my big pet peeves today. And then after that, I'll say a few words on the big picture, and to the extent that I can, try and offer some insights into what's going on with markets. But starting with that pet peeve, my view, I think one of the most dangerous narratives I see out there in the market today is this idea that, gosh, with the RBA lifting interest rates so much, I can finally get a decent rate of return by just parking my cash in a savings bank and not having to worry about investing and take all the risk with investing. And it's certainly true, a term deposit today at a Commonwealth Bank or a NAB is going to pay you 4.2, 4.3%. At the start of last year, that same term deposit was paying 0.3 of 1%, barely above zero. So you've had a huge increase in interest rates in a very short period of time. What's dangerous about this line of logic, that cash has suddenly become an attractive investment class, is it, of course, ignores what's going on with inflation. Inflation is often referred to as the silent tax. Silent because we don't see it reaching into our pockets and grabbing our money the way we see governments do when they tax us directly. But just because we don't see it doesn't mean it's not there. It's a very real phenomenon. I've put up here the current CPI in Australia, the current inflation rate, and then a couple of the parts of the basket that affect all of us: housing, healthcare and food. And hopefully it's quite self-evident when you look at this chart that while it's seductive to have this idea that I can just put the money in the bank and not having to worry about investing it to preserve the value of my wealth, it's quite a precarious position to take. If you're putting money in the bank today, you're guaranteeing yourself a real-world loss of a couple of percent. And that's, in my view, not a particularly exciting option to do. And I think the seductive narrative that's tripping a lot of people up is just because the interest rates have gone higher, it might feel like you're earning a good rate of return, but in truth, nothing's really changed.
So you're saying when inflation was running at 2% and we were all getting paid zero on our bank accounts,
you were losing 2%.
We were losing 2%,
yep.
And now inflation's running at 6% and we're getting paid 4%, so we're still losing 2%. I get it.
So the equation hasn't changed at all. There's some interesting corollaries to that, and I think in terms of GVF, we're well aware that for us to generate the same returns that we've done historically, so if you look at Emma showed that we've annualised just under 11% in the past, we've done that in a very low inflation environment. For us to generate the same kind of growth in the real value of shareholders' wealth, we need to be doing better in the future. And we spend a lot of time thinking about that, and we're certainly well aware that that's our task now, is that future returns have to be better than our historical returns.
Oh, so this is a double good news day. Okay.
Well, if you ignore inflation, yes. And how do we get to those higher returns? Well, in theory, that first source of return that Emma was referring to before, the underlying market returns that we receive from the assets that we own around the world, that should be doing all the heavy lifting for us. Just, economic theory, finance theory tells us that as interest rates go up, the baseline expected return on all asset classes is supposed to increase in tandem. So if cash interest rates today are 4%, you should be getting an interest rate of 6 to 8% lending money to a company like BHP. A couple of years ago, we were only getting 2 to 4%. So you can see there's a big increase in what you get in your lending book. And in our debt holdings at GVF, you remember that was a big part of the GVF portfolio. It's been really pleasing to see places where we used to get interest rates of 2, 3, 4%, we're now getting interest rates of 7, 8, 9, 10%. And in some of the really interesting, slightly spicier parts of the portfolio, we're getting interest rates in the mid-teens. Really exciting. So we've seen a direct pull through of these much higher interest rates come into the returns we're getting from our lending book. It's important to understand here, however, what happens to those old bonds when interest rates go up a lot. So if I was saying today I can buy a bond from BHP that pays me an 8% coupon, BHP has old bonds on issue that pay a 3% coupon. Now, if I'm a bond investor, I'm a lot more excited about a bond that pays me 8% than I am about one that pays me 3%. So what happens in the market to keep parity is the old bond falls in price to a level where you get parity across the two instruments. So I can buy a new bond that pays me an 8% coupon, or I can buy an old bond that pays the old 3% interest rate, but I'm buying it at 90 cents on the dollar, and overall I get the same sort of interest rate. I spell that out because that's a very important dynamic in finance. As interest rates go up, the value of historical asset prices, in theory, is supposed to go down. And that principle is supposed to be what's happening in the share market and hasn't really yet. Once interest rates have gone up, asset prices fall, and it's from this new lower base that you get the higher expected returns coming through that you're supposed to get as part of how the whole framework holds together. Can we jump to the next one? Yeah. What concerns me, just thinking about the share market and trying to offer my 2 cents, what concerns me a lot today, and I know a lot of other kind of commentators in the market, is we haven't really had the big pullback in the share market that you would normally expect when you get a big increase in interest rates. We've had it in bond prices, like I just said before, but we're yet to see it in the share market. And hopefully these two charts give a little bit of an insight into that. The first chart on the left, you can see the navy line, that's US interest rates. And against that is an index of global corporate and government bonds. You can see as interest rates fell after COVID, bond prices went up. And then as interest rates started to go up again at the beginning of last year, bond prices fell almost in tandem. Those two charts are basically a mirror image of each other. It's that principle I'm talking about. As interest rates go up, the value of old bonds falls because they pay a lower interest rate than what you can get today. The second chart shows the same US interest rate, the navy line, and then against that I've got the S&P index. And you can see that the principle started to happen as interest rates started to go up at the beginning of last year. From there, you saw the share market started to fall. However, it stopped falling about this time last year, raced around and reversed, and has been grinding higher ever since, despite interest rates going up and up and up. And that kind of goes counter to what finance theory should be saying is going on in a situation like this. If we rewind back to this time last year, it probably represented a bit of a peak in terms of market bearishness, as I was saying, for the share market. As I was saying, rising interest rates is normally bad for asset prices. And on top of that, there was this big consensus in the market that in trying to tackle inflation, central banks would lift interest rates a long way and it would end up putting the economy into a recession. And if you remember, about this time last year, a lot of the papers, a lot of the commentators were saying 2023 is going to be the year where the chickens come home to roost and we're going to finally have a big recession. You fast forward to today and that was completely wrong. So it just shows you the papers don't have much more insight than flipping a coin. Share markets are up 20% since then. It's been a tremendous rally. There's been two things that have driven this kind of share market move, which in theory is really defying gravity. The first one has been artificial intelligence. I'm sure a lot of you have seen all the kind of hoopla about AI coming along. And for the big cap tech stocks that are supposed to be the winners from this big AI, artificial intelligence theme, they've had a tremendous run in share price. There's been a huge amount of investor enthusiasm in the space. A lot of it is still to be tested. None of these companies are generating much revenue from AI yet. But those 6 sort of tech stocks have increased by about 50% on average over the last 12 months, which is an enormous move for big, large cap companies. And those 6 stocks on their own have carried the index higher. They make up about a third of all of share market returns over the last year, which is quite unusual on its own. And then the second thing that's dragged markets higher is that first point I was saying about we all thought there was going to be a recession this year. It hasn't come along. So the economy is doing better than everyone thought. There's been a bit of a sigh of relief and companies are earning more money than people originally thought they would. Those two reasons on their own could be sufficient for share markets to defy kind of economic logic and keep going up. Shares are a very special asset class. So as well as being driven by interest rates, they're also driven by what people think earnings are going to do. Artificial intelligence could come along and create vast new earnings for the companies involved. Underline the word could. And a stronger economy today means all companies are earning a bit more money than we thought about. The flip side, I think, of the economy doing better and central banks not yet winning the war of inflation and economies like the US continuing to run really, really hot. And I think this is the sort of the flip side markets haven't really thought about too hard, is that interest rates are going to have to stay much higher for much longer and possibly go higher from here because the game has not changed. We've still got to get inflation back to the levels that central banks want them to be. So that notion of interest rates staying higher for longer, I can see that playing out in a lot of other asset classes. I don't think it's been priced into the share market yet. I mean, one of the things about share markets that we all know is it's prone to kind of excessive optimism and excessive despair at different times. And I think that, well, look, there's an old joke. I put this in my letter to shareholders. This old joke that my dad always tells, which was the original dad joke. If you want to make God laugh, you tell him your plans. This time last year, there was a lot of bearishness in the market. It was completely wrong. Markets have had a tremendous run. What I worry about a bit today is that there's possibly excessive optimism now with people too excited about AI and the near-term kind of sugar boost of no recession this year and not keeping their eye on the fact that it probably means there's a bigger recession next year and that we will all have to pay the price for that. I don't know how it's going to pan out. I guess in terms of how we're positioning the GVF portfolio, we're very excited about the debt side of the business at the moment. We're seeing these big pickups in yields. It's coming straight through and should be increasing the returns we're delivering through to you. On the share market side, I guess we still own some share investments, but we're owning them with bigger margins of safety and we're being a little bit more cautious. And I guess I don't quite have the confidence there that we're going to see this big pickup in expected returns that we're supposed to see from sort of finance theory. But the main takeaway, if I haven't lost you, and you should hold this to everyone, including ourselves, as interest rates go up, expected returns on all asset classes are supposed to go higher. I need to be standing up here and saying we should be doing better than we've done historically because inflation's higher, and all of your fund managers should be saying the same thing. Higher interest rates should mean higher returns across all types of investments. That's my attempt to look into the crystal ball for you.